Hello and welcome. This is the show that makes sense of the important developments of the day. This is the big picture. The Reserve Bank of India delivered a stunner today as it left interest rates as well as the cash reserve ratio or CRR unchanged, defying widespread expectations for a rate cut and warning that relaxing policy could worsen inflation. As an immediate reaction, stocks, bonds as well as the rupee witnessed a fall as news of the unchanged policy spread. The Reserve Bank of India kept its policy repo rate unchanged at 8% and left the CRR for banks at 4.75%, putting the onus on the government to take measures to revive flagging economic growth. Growth has fallen in recent months to a disappointing 5.3% of the GDP, and in the backdrop of ratings agency Standard & Poor issuing a statement that India could be the first BRIC economy to lose its investment grade status, industry had been clamoring for another rate cut. The RBI has warned that a further reduction in rates at this juncture, rather than supporting growth, could exacerbate inflationary pressures. Industrial data in April had suggested that there is no great hope that the economy will pick up soon. And to make matters worse, the government has been hampered by its political compulsions, hence unable to drive reforms. A worsening fiscal deficit also limits the government's ability to propel growth and provide stimulus. On the other hand, the Eurozone crisis does not seem to have an end in sight, a factor which is sure to weigh heavy on the G-20 meet in Mexico, which brings us to the summit itself. The group of 20 leaders are expected to pile up the pressure on Europe at the summit to outline a lasting strategy to save the euro currency and end financial turmoil. Tonight on The Big Picture, we'll touch upon both the developments. We try and analyze the RBI's move to leave rates unchanged, and we'll also cast an eye on Los Cabos and ask our panelists what to expect from the summit. I'm Athar, and joining me in the studio tonight is Krishna Kumar, who teaches economics in Delhi University, also a friend of the show. Also on the show tonight, Renu Kohli from ICRIER will be joining us. Later in the show, we'll be joined by Venu, Managing Editor of the Financial Express. Also, a bit later in the show, we'll be joined on the phone line from Mussoorie by Rajiv Kumar, Secretary General, FICCI. A very warm welcome to all of you. I'd like to start the show with Renu Kohli, if I could. Ma'am, if you can hear me, there was widespread expectation that the RBI would further ease rates, perhaps by another 25 basis points. It hasn't happened. Are you surprised by the decision, or did you sort of expect it at some level?
No, I'm not at all surprised. I think market expectations were wrong. They originated primarily from the comments of Deputy Governor Shubir Gokan earlier, which was in fact quite a balanced comment, which said that, okay, of our interest rate reduction, slowing growth, and lower crude oil prices do offer some room for cutting interest rate, but at the same time, lack of fiscal adjustments and resurgence of resurgence of inflationary, the risk of inflationary pressures balance that out. Subsequently, 2 days later, a second deputy governor said quite clearly that interest rate reduction higher interest rates were not the only cause for growth slowing. So I sort of expected the RBI to hold interest rates, and indeed that was the right thing to do, because inflation risks haven't quite subsided as yet, as it points out. And furthermore, high interest rates are not the only reason why growth has faltered.
Right, ma'am, we'll touch upon that point a little bit later in the program. Right now, joining us on the program is Venu, Managing Editor of the Financial Express. Welcome to the show, sir. Same question goes to you, sir. Did you actually expect the RBI to keep policy rates steady, or were you in fact surprised, because industry has been clamoring for a very long time for another rate cut? Your views on the developments today?
Well, I was expecting that the RBI would make another 25 basis point cut, and there was also some expectation that there would be some CRR, a minor CRR cut to ease liquidity. Now, this was a consensus view. Everybody was expecting RBI to do that, but obviously RBI seems to be going by the new consumer price index, which is showing double-digit growth. So in my view is that RBI will from now on, will really have to do some creative thinking, because growth has virtually collapsed. We are now down to what many describe as the neo-Hindu rate of growth.
Right.
We got 5.3% last quarter, the last reported quarter, Jan to March 2011. And the investment cycle, more worryingly, the investment cycle has virtually come to a halt. So, RBI, while RBI is right in saying that the fiscal policy has not done its bit, that is true, but that's become an old story now. So RBI obviously has room now to do a lot to kickstart growth. Sometime or the other, we'll have to think about it.
Right. Venu, hold that thought. We'll get an industry reaction right away. Before I come to Krishna Kumar in the studio, Rajiv Kumar is joining us very kindly from Mussoorie. Sir, industry obviously is not happy. You have issued a scathing statement. FICCI has issued a scathing statement saying that the inflation-centric policy of the RBI will not work. Millions of lives are at stake. Your views on the developments today, Rajiv Kumar? Right. We seem to have lost the phone link with Rajiv Kumar. We'll try and get back to Rajiv Kumar. Let me come to Krishna Kumar right now. Industry, or India Inc., as we call them, has taken a very stern view of the decision to keep policy rates ready. The charge being that inflation-centric policy is not going to work. The RBI is missing the big picture where lives and jobs are at stake. I say that India Inc. is being too harsh on the Governor Subbarao. What are your thoughts?
No, because precisely in the last quarter, we found that the percentage of growth in the manufacturing sector was too little, too less. And remember that we have got a very low employment intensive manufacturing growth which is occurring now. So on two planks, in fact, it was expected from the part of industry and the part of economy at large that there would of course be a rate reduction at least by 25 basis points, which did not occur. Possibly the central bank might have decided in this line, in the specific context, in the backdrop of the fact that they didn't want to create a larger interest rate differential with the rest of the world, because now I think there are exchange rate considerations which are also occupying the interest of the central bank. But it was expected that given the contemporary scenario where you have interest rates which are low in the rest of the world prevalent, to what extent this lack of interest rate reduction, because it's not a case where you can have either fiscal measures or monetary measures. In fact, there should be capex-led fiscal measures which should be supplemented with a rate reduction in the monetary level.
Right.
The composition of fiscal expenditure might be an issue which the government can in fact think about. But the central banks, in fact, it should definitely,
right.
I think the industry is justified that it was a definite shock.
Krishna Kumar, let me interrupt you there. We seem to have regained a contact with Rajiv Kumar. Mr. Kumar, welcome to the show. My question to you, of course, FICCI, in fact, one of the industry bodies that have shot off scathing letters and statements saying that the inflation-centric policy of the RBI is missing the bigger picture. How do you see, since you're on the program, how do you see today's developments, and do you think the RBI has in fact missed the bigger picture? Your thoughts, sir?
I think the RBI has missed the bigger picture, and the RBI itself says that the persistent inflation is because of supply side bottlenecks, and it says that in its own statement, and also says because of inflationary expectations. Now, the other fact to note is that the highest inflation rate within the WPI and the CPI is that of food articles, especially that of vegetables and proteins. Now, I cannot see how supply-side constraints in general and the prices of vegetables and proteins in particular will be brought down or addressed by leaving the interest rates as high as they are. So my own understanding of the situation is that this inflation, which is there, is supply side, and therefore you need to increase the capacities, remove the supply side bottlenecks. So by keeping the interest rates high, the RBI is actually preventing that to happen.
Right.
So what we will get as a result of this is the combination of lack of government policy action and RBI's continued high interest rates. We will just go along into what we call a slowflation,
right,
which will give us the worst of both the worlds,
right,
low growth and high inflation.
Right. Slightly digressing, let me come to you again, Rajiv Kumar, because we know you're a busy man. You might have to go and you might not be able to join us later. The rupee depreciating, slightly digressing from the point here. The rupee depreciating, some would say, has already given a bit of a demand stimulus to India Inc. Export markets have become a little easier for industry, or India Inc. as we call them. Would you say that the rupee has been a bit of a, the rupee depreciating has been a bit of a stimulus for the industry? Would you agree with that view?
No, I don't think so. You see, because what's happened is that because of the rupee depreciation, in fact, the importers in other countries are demanding that forward contracts be renegotiated. And at the same time, the rupee depreciation has meant that the softening of the global oil prices has not been passed on to the consumers because the rupee has depreciated, so that the disinflationary impact of lower crude prices has not come through. So the rupee depreciation is actually because of the flight of capital, and I don't see that with the macroeconomic situation being as it is, how this will be improved. So export demand may improve after 6 months, but at the moment the rupee depreciation, because it has been too sharp,
right,
has not benefited export demand at all.
Right. Rajiv Kumar, thank you so much for joining us on the phone line from Mussoorie. We'll take a short break right now. We'll come back to Mr. M.K. Venu right after the break and ask him some other question that we have from him. Don't go anywhere. Stay tuned. Keep watching The Big Picture. Welcome back. You're still watching The Big Picture, and still with us is M.K. Venu, Managing Editor of the Financial Express. Sir, let me ask you this. We just heard from Rajiv Kumar, who's obviously representing the industry, Secretary General of FICCI. Now, they also say that the absence of any major economic reforms coupled with continued high interest rates by the RBI. Now, the economy is headed for a long period of slowflation, which is just mentioned, which can bring India closer to a full-blown crisis. Would you agree with that view, first of all?
Well, there are people who are saying that we are staring at a stagflation, but I don't believe that that stagflation is a certainty. We can still retrieve the situation. All I'm saying is, I mean, I agree with Rajiv Kumar that that growth has to be addressed now in a much more focused way, while inflation is a problem. But as everybody is now saying, if food inflation is due to supply side problems and core inflation, which is manufacturing inflation, which is at a reasonably moderate level of 4.9%, and for monetary policy purposes, you look at manufacturing inflation, core inflation. So that seems to be all right, and global commodity prices are slipping. The world growth is endangered because of the euro situation. If you take all that into account, there's a huge climate of pessimism, investment pessimism, and if you take all that into account, there is a need for the RBI to cut interest rates to give that little boost. And if RBI doesn't do that, I don't think it will be able to address either inflation or growth in the future. I think it'll just abandon both, because inflation is not getting corrected, not coming down because of supply side problems, but the RBI's high interest rate policy is not addressing that. So at least they should address growth if they can do that. Yeah.
Right. Venu, before you go, one last question before we let you go. Los Cabos is the place to be today. The Prime Minister is there and the G20 leaders are there. Any major announcement or agreements? Are you expecting any major announcements, especially given the fact that the pro-bailout parties in Greece have won the election by a narrow margin? Any important announcements or agreements do you expect to come out of Los Cabos?
No, I don't expect any concrete announcement from Mexico, simply because the world economy, the G20 economies are all in a disarray. They are following their own national, they are only focusing on their national crisis, their own policies. And G20, as you know, it was formed in the backdrop of the 2008 crisis, when everybody was down, and there was coordinated policy taken by everybody, fiscal and monetary. But now different nations are in different in different situations, as it were. Emerging economies are in different situation. Eurozone has its own problems. US has its own problems. So very difficult to come up with a coordinated policy framework. Very difficult. I don't have hopes.
Right. MK Venu there, Managing Editor of the Financial Express. Thank you so much for joining us on the show. We'll have to let you go right now. Coming to Ms. Renu Kohli for a bit now. Renu, you obviously heard what the other guests had to say on various questions. I asked him, I have a question for you now. Now, would you say that front-loading in the April meeting, when the RBI last met, when the RBI delivered a 50 basis point cut in the repo, could be one of the reasons why the RBI chose to keep rates steady this time around, saying, look, last time around we delivered a bigger than promised cut in key rates, and right now we want to just wait and watch where inflation goes, where growth goes, and then perhaps take a call. Do you think that was the rationale behind the RBI's decision to keep rates steady?
The monetary policy statement does say that the 50 BPS cut in April was front-loaded, and that was the intention. And that was its, in the hope that this would be backed and complemented by fiscal adjustments which were promised. And there are no two views about the fact that both monetary and fiscal policies have to complement each other, particularly at a juncture where an economy is facing stagflation, as India is at the moment. At the same time, I would just like to draw attention to the fact that the 50 BPS cut in April has actually failed to transmit itself onto lower interest rates or into the larger economy. And there are deep structural reasons for that. A major reason is intense shortage of liquidity or scarcity of resources in the economy. Banks are loaning out nearly 77 to 78% of their deposits. Deposit growth is already sluggish at around between 13 to 14%, and that is juxtaposed against a credit growth of in the range of 16 to 17%. So how do you expect lower interest rates to RBI's rate cuts to transmit in that situation? Because even if they were, you're not going to have a situation. You basically have a mismatch between demand and supply of resources, of cash, of money, and of resources, and it's not going to happen.
Right.
So I think the central bank would look rather awkward doing such a thing.
Right.
Clearly, the deeper structural reasons for this are a fall in the national savings rates, which is coming primarily from a fall in both corporate savings as well as government savings.
Right, Renu. Let me get Krishna Kumar. Let me get Krishna Kumar on the same point. Do you agree with what Renu just said?
Ma'am, I would also like to know from you specifically what your take would be on this particular case, that given that the economy is sluggish per se, the credit uptake is not forthcoming because there are no feasible projects. So don't you think at this particular time there should be a proper capex expenditure upfront or upscaling from the part of the government in such a way that the credit uptake would also assume a momentum and give a growth, put the economy into the growth track? What we are now trying to say is that there is no credit offtake per se. But credit offtake is not occurring precisely because there are no feasible projects coming up. And the business environment is not, that is, the animal spirits in the economy is not got a trigger. So don't you think at this juncture, there should be a capex upscaling from the part of the fisc side?
Right. Ma'am, that's a question for you.
I think I lost a bit of the question in the audio, but never mind. If I've understood it correctly, it is that there's got to be a boost to capex from the fiscal side. Am I correct in my inference?
Absolutely, ma'am. Go ahead.
Yeah, I couldn't agree. I couldn't agree more with that situation. There is only so much that a central bank can do to revive growth, and that is primarily by influencing the cost of capital. But when there are reasons which are underlying, which are keeping the cost of capital very high, there's not much that the central bank can do to revive growth. It has it has to look at price stability, and one must remember and one must recall that interest rates are not the only cost, or it's not the only factor that influences investment demand. Other factors which are equally, if not more so important, is the role of uncertainty and price instability itself. Volatility is not at all conducive to investment.
Right.
And if you have price rises, you have input costs rising, automatically, I mean, firms cannot take a view of investment, if prices are rising. I mean, which firm will plan to expand capacity when it does not know where inflation is going to be 6 months,
right.
1 month, 1 year hence?
Right, Renu, I have a little question for...
I mean, price stability is as important for nurturing growth.
Right. Point taken, ma'am. Stay with us. We'll come back to you in just a second. Krishna Kumar, I have a small question for you. We've been talking about how the RBI says that the main reason of the economy not doing well and inflation getting triggered a lot is not just high interest rates, also a drop in investment levels. But my question to you is that, given the fact that the RBI is saying that, aren't the two, the drop in investment levels and high interest rates, sort of intrinsically interlinked?
That's exactly the point, because there should be much more mutual cooperation between the fiscal establishment of the country and the central bank of the country. Because to leave everything to the central bank, or to leave everything to the fiscal establishment, or saying that the other should take care of the rest, this sort of a thing doesn't work now, because we are like something like a liquidity trap, or like something like, there's no meaning in reducing interest rates also, one could say. But even at the levels of interest rate, for investment to be forthcoming, the government should be ready to give a big boost through proper capital expenditure increase.
Right.
So unless that happens, unless there is some sort of a coordinated action from the part of the monetary and the fiscal establishment, possibly we would not be able to address this particular issue.
Right. Hold that thought. We'll talk about a little bit more, especially the G-20 summit that starts today in Los Cabos, Mexico. Lots more on that with Renu, Kohli and Krishna Kumar right after this break. Don't go anywhere. Keep watching The Big Picture. Welcome back. You're still watching The Big Picture, and it's time now to focus on the G20 summit in Los Cabos in Mexico. My question to you, Renu, Kohli, of course, is according to you, what is going to be Prime Minister Manmohan Singh's focus in Los Cabos? We already know that in Greece, the pro-bailout parties have won the election narrowly. Do you think the focus of the G20 leaders, including Prime Minister Singh, is going to be that, look, give an ultimatum to the Greece government as well as the Eurozone nations that, look, come up with an outline, lasting solution for the economic crisis there. Otherwise, we all go down with you.
There's little doubt that the focus of the Prime Minister will be to see that or make an effort or to mount pressure upon the European leaders, EU leaders, to stabilize the situation in the Eurozone, which is prolonged. India's exposure to the European Union as a trading bloc is considerable. Roughly, both imports as well as exports account for 1/5 of India's overall total imports and exports. So, as we can see, its exposure to the EU is considerable. Also, it's not just the trade and financial channels that India is exposed to. There's also the confidence channel, and the effects of the wobbly euro situation have already been reflected and can be observed in India's balance of payments. In the last quarter of 2011, there was an intense contraction in capital movements, and that was primarily triggered by recalling of short-term credit loans from European banks. And that has contributed towards widening the current account deficit.
Right.
So there's little doubt that the Prime Minister's efforts will be directed there.
Right. Krishna Kumar, same question to you.
And if I may add...
Ma'am, I'll come back to you in just a second. Please stay with us. I need to get Krishna Kumar in right now. Krishna, do you agree with Venu? Of course, is that going to be the focus, or is there something else on the agenda?
No, but in that particular thing, there should be certain insistence with respect to the financial regulation per se. Because we should remember that the origins of this crisis is precisely because of transfer of different private debts, which would have actually created a banking crisis. The governments in different countries in Europe had to own them up, which resulted in a big fiscal deficit of sorts. So fiscal deficit is not something which came because of fiscal imprudence from the part of the governments per se, but it was because they were trying to save the banks from a larger disaster in the economy. So unless there's some sort of an effort towards harmonization of financial regulation, I do not think the meeting would be worth the while. Because G20 countries are otherwise also, though of course G20 countries are not wholly representative of the whole world, because we should remember that this is also some sort of an exclusive club. And this also has got lots of conflict of interest. For example, India has got interest with respect to if it's issues relating to financial transactions tax, etc. I wonder whether India would be siding with respect to the same, or even with respect to certain sort of Macau sort of centers, that is all the centers of tax havens, because they are all pronouncing systemic financial instability in the global economy. So how collectively, a collective effort can be made rather than basically focus on some simple issue, some issue. Of course, the important issue, Greece is an important issue, but though Greece is there, I think the larger picture has to be addressed by the G20 leadership in a very significant way.
Point taken, sir. Last word on the show. Let's give it to Renu. Kohli, ma'am. It's being reported that Obama and Prime Minister Singh will have a pull-aside meeting on the sidelines of this summit. Mr. Singh is also due to have bilaterals with the host country president, Felipe Calderon, German Chancellor Merkel, Canadian and British Prime Ministers Harper and Cameron, and also French President Francois Hollande. What do you expect to be the top of the agenda in these bilaterals, especially with the European leaders? And also, you had a point to make. If you could wind up in less than a minute, we have absolutely no time left, ma'am.
I think at the top of the bilateral agenda would have to be attracting foreign investments, and because that's what India needs most at the moment. So that has to be at the top of the agenda. And if I have more time, I would just like to add something which the Prime Minister has very often stated during the G20 summits, which is to attract foreign investments into the infrastructure sector. And it has always, for last 2-3 years has argued for rerouting of surplus countries towards infrastructure investments in developing or needy countries.
Right. Renu Kohli, thank you so much for joining us on The Big Picture. Krishna Kumar, thank you so much for joining us on The Big Picture. Of course, there might be differing views on what the RBI did today, keeping policy rates steady. But there's one thing that nobody will argue on. It's that the road ahead for the RBI and the government is not an easy one. They'll have to dig deep and come up with a solution and change the inflation growth dynamic currently, which is not looking very good, Krishna Kumar, right? That's all we have for you from The Big Picture in the studio tonight. Thank you to all my guests. Till next time when we get you another edition and another important issue from The Big Picture. This is Athar Khan saying goodbye and thank you for watching.